Good morning, traders, and welcome to the weekly video analysis. Hope it finds you well, and you're no doubt looking forward to the weekend. Last week, a very active, very volatile week, and more importantly, another profitable week. So plenty to go through. So without further ado, I'm going to go through the last week's calendar, talking through all those really interesting news events and why they moved the market in the way they did and what that means going forward. Then we'll have a look at the three trades we took, and then we'll have a look at next week's diary, because again, there's another interesting week ahead of us, and hopefully we can further add to our profits for the month and squeeze well into that zone between 1 to 5%. We've just crept in it this week, which I'm pleased about. If we can push a little bit further into it, then that would be absolutely fantastic and squeeze ourselves out another profitable month. Okay, so let's go through last week. So it started off with the Eurogroup meetings. The interesting bit came on Monday because there was an agreement finally after months and months of deliberations, months and months of going backwards and forwards. Finally, Greece accepted the deal, accepted the bailout, accepted all of the tough conditions as part and parcel of that, and finally there has been a line drawn underneath it. Now it still means it's a little bit tricky to trade the euro, purely because there's still ongoing meetings to really wrap everything up. But essentially what you'll have noticed is after several months of the euro being very choppy and heading up and then down and then up and then down, we've seen it start to kick in, because the market's almost... They've had a big sigh of relief, because it's like finally everything's gone away. All of the conflicting comments have gone away. Now I have clarity. The fear has gone. Now let's have a look at the overlying fundamentals. Europe's still in a bad way. They're still adopting QE. The euro is still weak. And for those of you guys in the UK like myself, an optimum time to be going over to Europe for a holiday, because the pound euro exchange rate is absolutely fantastic right now, and that's probably going to continue because Europe and the UK have got what we call diverging central bank approaches. In the UK, as we found out last week, they're heading much closer to a rate hike, which is positive for the pound, whilst in Europe they're in the middle of their recovery, so they've still got a long way before they even consider raising rates. They're still in QE, so really going forward the euro is going to remain weak against the pound, so I foresee that the pound euro exchange rate is going to continue to improve for UK guys, and the euro pound currency pair is going to continue to fall. Again, not just one directionally, it's not just going to head down continuously. You are going to get pullbacks, but might be a nice currency pair for you guys to keep your eye on, because now that we've got the European issues moved out the way, that really should open up the door now for further euro weakness. Again, the analysts have come out and started to talk about euro against the dollar hitting parity over the next few months, so we can consider euro weakness going forward. And as we go into 2016, we've got the potential of a rate hike in the UK, as I'll discuss in a second, because that provided us with that release of information provided us with an opportunity this week. So the fundamentals are now starting to kick back in on the euro now that the euro meetings are out the way. Then as we moved into Tuesday, we had some business confidence figures out of Australia. However, they came in better than previous, so that was slightly positive for the Aussie. Doesn't change the bigger picture, but I wouldn't have traded it purely because my bigger picture analysis on the Aussie, or my longer term perspective, is that the Aussie is weak. So even if I get positive data, I'm not really going to trade that because it doesn't line up with the bigger picture. Then as we move through, my focus on Tuesday was really the UK data. Again, what you'll notice from all the reports is I'm always looking for a deviation to support my intended trade plan. So before every news event, I have a trade plan or a trade idea in terms of how I want the news to come out. In regards to this event here, I was looking to trade pound CAD, or pound against a weak currency pair, only if we got better than expected inflation data. Why was that? Well, the Bank of England have openly stated and communicated to the market that they want to see inflation start to improve before they raise rates. So if inflation beat the expected, the market would take that positively and start to buy the pound in the expectation that now the Bank of England is getting closer to a rate hike, which is really the biggest, most market moving event. A rate hike or a rate cut is really what causes the market to move, and the expectations of them obviously creates buying and selling as well. However, it came out flat. So for me, whenever the news comes in as expected, it doesn't give a deviation either way to give me an edge. So I simply didn't trade it. So as frustrating as it may be, because you plan, you get ready, you set yourself up. If it doesn't do as I expect, you normally get mixed movements, and as we saw from the pound reaction, it was a very muted response because the market was hoping for a better than expected figure. It didn't get it, but it didn't get a worse figure to give them an excuse to sell it off. So really it was a non-event. Unfortunately, very stagnant inflation reading, but the Bank of England has come out and said that they expect inflation to start ticking back up over the next few months. So if that is the case, then that's going to be positive for the pound. So as we move down, we then got some sentiment out of Europe. Again, came in worse than expected, so the sentiment in Europe is bad. That aligned with the bigger picture. We saw a little bit of a sell-off on the euro. Nothing dramatic, but certainly added to the woes of the euro this week. Then we got the interesting part of the morning. And this is where the news feed, the FX Pro news feed that I listened to, this is where it has its weight in gold. And proves to be hugely beneficial. The reason for that is because it provides breaking, unscheduled news. And in this particular example here, I was expecting Carney to speak at 12:45 as listed by the calendar. He actually started speaking a little bit earlier. So the Squawk feed communicated that. They said that Mr. Carney, who's the head of the Bank of England, is about to speak. And he came out and he said this beautiful comment. He said that they are heading closer to a rate hike in the UK. So he said that they are heading closer to a rate hike in the UK. So as you already know, and what I've just explained is, if a nation is heading towards a rate hike, that's positive for the pound. Especially if the Bank of England, who is in charge of raising rates, starts to communicate that. That is very bullish for the pound. So when it came out and said that, and I think hopefully you've watched my other video that I released earlier on this week. You'll have seen the exact comment that I looked at. And that was given on the audio. I heard it as soon as I heard it. Well, actually, not as soon as I heard it, because I was otherwise engaged at the time. So I heard it from afar. But I had to get back to my charts, but I was a little bit delayed, frustratingly, because I normally like to be at my charts as soon as I hear it, because then I can take full advantage of it. So I did get a little bit late into the trade. So I took pound CAD based on hearing that bullish comment for the pound. Why pound CAD? Well, I didn't really want to put the pound against the dollar because the dollar is strong right now, and if you put strong against strong or weak against weak, you don't get as much movement. So I wanted to put the pound against a weak currency pair. I chose the CAD because there was a lot of expectation heading towards the next day, where the Central Bank of Canada were due to release their update, or their economic update, or their monetary policy statement. And a lot of market participants were expecting them to turn more bearish, or communicate a more gloomy picture for the Canadian economy, which is bad for the Canadian dollar and thus should weaken it. So I chose pound CAD in that presumption that the pound would be strong off those comments and the CAD would remain weak going into Wednesday's big event there. So I took a trade on pound CAD, just got in a little bit late on the trade, and this was a little bit of a tricky. I'm a bit frustrated with myself this week because I should have got into trades earlier than I did and squeezed out more profit. However, I didn't, and because I got in late on a couple of the trades I took this week, I decided to take smaller profits than what I'd initially anticipated based on the news. However, hopefully you can see the overall reasoning as to why I took the trade. So I took a buy trade on pound CAD because of the bullish comments from Mr. Carney. Thank you very much. And the weakness that we're currently seeing on the Canadian dollar. So that was a wonderful, out of the blue, unexpected little present to a trader that trades off the news feed. So really, really powerful stuff there. And really, we saw the pound strengthen throughout the week, and the pound should remain buoyed for the next few months, really. So long as data continues to outperform, the market's expectations now are for an early 2016 rate hike in the UK, rather than the initial expectations before that comment, which were late 2016. So now things are starting to heat up in the UK in terms of rate hikes. That's good for the pound. Not so good for households, but good for the pound. Okay, and then later on in the day, we got some really bad dollar retail sales. So that didn't create much of a reaction because retail sales aren't really high on the agenda for the Fed. But again, I didn't trade it because Remember, we want to get our bigger picture analysis in sync with our shorter term economic news. So I am bullish on the dollar because of the US heading very close to a rate hike in 2015. So I'm bullish on the dollar, so I want to be buying the dollar. When it came out bad, that was obviously going to create a little bit of uncertainty and a little bit of weakness. I don't really want to sell the dollar because the bigger picture is saying buy it. So if I sell the dollar, I'm just going to make life hard for myself. Had it come in good and those figures had beaten expectations, I'd have looked to buy the US dollar. And the great thing at the minute is we can buy it against a lot of different currency pairs because there's a lot of weak currency pairs out there. Think Euro, think Kiwi, think Aussie, think CAD. So again, I had a plan. I was at my charts. I was ready to trade it. However, the plan didn't come to fruition. So I left the trade alone, and that was that. Then coming into the next day, a big day for the Canadian dollar. It's also a big day for the Japanese yen, but the Bank of Japan literally just said, we are happy with how things are going, no change. So they didn't really give any fresh information to trade off. It's just, we're happy with how things are going, and we're going to continue this path. Will they add to their QE stimulus in due course? Possibly. So I'll continue to monitor them, but this particular one was not a market moving event. Then as we went into the early morning, again, I had a plan to trade the employment data from the UK. So we had average earnings, so that's wage growth, and we had claimant count. So I wanted both of these to come in positive to support what was said the day before by Mr. Carney. However, we got a mixed picture. So average earnings still came in good, 3.2%. It's still pretty good. It's better than previous, but it didn't beat the expected figure. So it wasn't as good as what the market was expecting. So a slight disappointment there. But the greatest disappointment came in the claimant count change. Because the market in the UK, it's been negative for several years now. So every single month, there has been people coming off benefits. So minus 8,000, which was last month. That was what was expected. The market expected nearly 9,000 people in the UK to come off benefits, which is good for the economy because more people are going into work. It actually came in at plus 7,000, which is a bad figure for the claimant count change, because it's saying that 7,000 people were added to claiming benefits, which isn't good because it's an unemployment reading. Also, the unemployment rate ticked higher, which again is worse for the UK because unemployment rate we want to see as low as possible. Claimant count change we want to see as low as possible. These two came in higher. So overall, it was okay because average earnings, wage growth was good. That's important to the Bank of England, but the other two elements weren't great. So it was a mixed picture, so I didn't trade it. And as we saw, we got a very muted response on the pound. Had these all come in good, I'd have, without a doubt, bought the pound against a weak currency pair. Okay, so as we then moved into the afternoon, we got the Eurogroup meetings carrying on. We got manufacturing sales out of Canada, which came in worse than expected, so keeping the pressure on the Canadian dollar. I didn't trade that because I preferred to have waited for the actual larger event that was taking place that afternoon. We got some good readings on the US PPI, which again supported the dollar. We also had Janet Yellen speaking throughout the week. She was testifying to Parliament, and she was saying essentially, and she's known to be very dovish or bearish, but she actually came out and said, yeah, we are still on track for a rate hike in 2015. So she kept the momentum behind the dollar bull, so any good data was acted upon. Then as we went into the afternoon, this was the frustrating bit. I must admit, being a guy, I'm not great at multitasking. I was planning for this Canadian rate decision. So the overnight rate, I was waiting for it because as I explained in last week's video, when we were looking forward, I said that we could potentially, it's an outside bet, get a rate cut and we'd get a big reaction. What we got just before that is, again, this GDT is the Global Dairy Trade Price Index, and that's the essentially the price of global dairy, so the milk prices essentially. And this is unscheduled every single time it comes out, so it doesn't have a fixed time, which is really, really frustrating because you have to listen into the news feed and then it will tell you. But again, the news feed broke that information in record time. And what it said is it came in at minus 10.7%. Absolutely shocking. So another huge drop in milk prices. Why is this bad for the Kiwi? It's bad because milk is a massive contributor to their GDP. if the milk prices are falling, they're not going to make as much money as a nation, and that has its complications from a wider economic perspective. So when I heard that, all I did was go, bang, sell Kiwi dollar. Why Kiwi dollar? Well, the Kiwi is massively weak. Cut rates recently. Central bank very, very bearish. And all the data points that are coming out are really, really bad. So while I was talking earlier how the bigger picture or the longer term perspective didn't match the shorter term economic news, this did. So I was already bearish from a longer term perspective on the Kiwi, and then we got bad data to support my negative perspective on the Kiwi. So what did I do is I took that weak Kiwi and put it against the strong dollar and sold Kiwi dollar for maximum effect. Now, I didn't squeeze as much profit from it as I should have done, but I want to give you the confirmation of the message as to why did I take that trade. This is the really, really important thing. And I took that trade because of the Kiwi being weak and the dollar being strong and having fresh reasons to sell the Kiwi, i.e. in the form of the GDT price index. And then we moved into the afternoon, further into the afternoon, and it was all about the CAD. Well, 10 minutes later, so I was busy getting myself, getting into the trade on the Kiwi dollar. I was busy sending the text out to you guys. I was busy monitoring it, listening to the news feed. So I had a lot of attention on the Kiwi. And what that distracted me from was the actual CAD information. So when I heard the CAD information come out, I was a little bit distracted because I was looking at the Kiwi. So in normal circumstances, I plan for one trade because I want to do one thing really, really well. But that Kiwi news was a little bit of a birthday present. It's like, here you go, here's a really obvious trade for you. So I took it because it was so obvious. Normally I would just focus in on one and do that really, really well. And as you can see from my entry on the CAD trade that I took, I'm not good at multitasking. So when I'm trying to do two things at once, I'm not very good at it, and my concentration on the Kiwi affected my CAD trade. So apologies about that. We did still manage to squeeze a good profit out on the CAD trade, but it should have been more. I look at that and I'm disappointed. It should have been more, and that's because I got a bad entry. So as soon as I got in late, I was a bit nervous as to how much further could it go. After it's moved 100 pips, how much further could it go? So I decided to take my profits quite quickly, when really, had I got in like a minute or 2 minutes earlier, I'd have probably had another 30, 40 pips on the table. So a little bit frustrating there, but hopefully you can see that I am certainly not invincible. I still do make mistakes, but I'm always open and honest about my own mistakes, so I can use that feedback going forward as to improving me as a trader. And essentially what they did is, and this is great because it brings it all together. It brings it all together. So last week we looked at the calendar and we said that this particular event could be quite interesting because we were expecting, because of such a bad run of data from Canada, we were expecting a negative change in their language. So they've been very, very neutral up to date, but we're expecting them to change their language and become more concerned and more bearish, which is obviously bad for the Canadian dollar. I wasn't expecting them to cut interest rates, but the fact they did, and it was a surprise, was marvellous, because that's when you get the biggest moves. When you get a shock interest rate cut or hike, that's when you get the biggest moves. We saw it on the Kiwi, we saw it on the Aussie, and we saw it this week. Even just a hint of a rate hike from the UK was enough to send the pound surging. So hopefully you're seeing this now and how powerful it is. And just on that note is I am in the process, I'm very close to finishing a full online course about how to trade the news, because it's all well and good me just sending out the text alerts, but what I want to do is educate you on the process that I follow in order to find these high probability trades, and for you to learn the skill yourself, and then for you to do a little bit more than me, because as a fund trader I'm looking to just get in and out, squeeze my profits out. As a trader just managing their own money, which most of my subscribers are, you can hold positions for longer. So you can go and squeeze, rather than take the 30, 40 pips I do, you can hold your position for a bit longer and maybe take 80 to 100. So I'm going to build a course specifically around trading the news, because as you've seen, it's so powerful. There are a few steps that you need to go through in terms of a structure of learning, but I'm going to document that all in an online course so you can go through that, so you can learn the skill yourself. The phrase that I love most is, you can give someone a fish and they can eat for a day, but you teach them how to fish and they become self-sufficient for the rest of their lives. So as well as the texts that go out to you and the support that I give you, I want you to also have the opportunity, if you so wish, to learn how to trade the news, because it's thoroughly profitable, and you get some fantastic moves as we're seeing. So there we see it, overnight rate dropped to 0.5. So the Canadian Central Bank came out and essentially said, we're concerned, we're very concerned, oil prices are stagnant and dropping. Most of the data coming out is really bad. Our economy, we're looking a few months ahead. We're a little bit concerned, so we need to act now. So a monetary policy strategy is to cut rates to try and help businesses earn more, help consumers earn more, spend more, hire more staff. All that cyclical economic approach starts with a little bit of central bank stimulation, which is aimed to then let all the areas or the aspects of the economy start to become self-sufficient. So that was really interesting. As I mentioned earlier, Janet Yellen testified and essentially said the US is on track for a rate hike in 2015. Dollar positive. Then as we move through, because I was at my charts literally all day on Wednesday, I was just absolutely knackered. I'm disappointed again. I'm kicking myself a little bit, even though this week has been a good profitable week. I'm a little bit frustrated with myself because we could have taken probably double the amount. But hey ho, this is a massive learning for myself. CPI, which is inflation. So we were coming into this event very bearish on the Kiwi. Why? Well, earlier on in the day we got an absolutely shocking dairy price, so that was bad for the Kiwi. The bigger picture is bad for the Kiwi. So when we got inflation come out lower than expected, that supported the bigger picture. So this was a negative reading, and as we saw, the Kiwi sold off another 70-80 pips off the back of that. Had I been up my chart, I would have traded it. I'd have sold Kiwi dollar or bought pound Kiwi to put strong against weak, and that would have been my approach into the market. But I wasn't at my charts. It was 11:45 at night. I'd just been at my charts from 6:30 in the morning through to around about 5 o'clock, and I was just suffering from screen stare and screen glare, and I just needed to take a few hours off and come back the next day. So I would have traded it had I been at my charts. It's another great example for you guys. You'll have seen the weakness come through the Kiwi off the back of that figure, and that just completely verifies that approach to trading the news. And then as we moved into Thursday, European news, ECB press conference and minimum bid rate, as was expected. They kept the interest rate the same, and the press conference was essentially, yeah, we're happy that the issue's been sorted out with Greece. We're happy with how QE's going. We're starting to see some positive signs, blah, blah. So really nothing new. They're just happy with how things are going. They don't need to do anything else. So really it wasn't much of a reaction to that. We got some slightly negative data out of the US. Again, manufacturing data. That wasn't tradable because it was a bad figure when we want to see good data to support our bigger picture analysis. And then as we moved into Friday, again, I was looking to trade inflation figures because we had inflation out of Canada and inflation out of the US. What I wanted was better than expected inflation out of America. Why? Because my bigger picture is I'm bullish on the dollar, and I wanted good data to give me fresh reasons to buy the US dollar. Also from Canada, I wanted to see worse than expected figures. I wanted the opposite to happen. Why? Because I'm bearish on the Canadian dollar, especially after this week. And that would have given me fresh reasons to sell dollar CAD, to buy dollar CAD, or to sell the Canadian dollar literally against the strongest currency pairs. However, they didn't do as I expected, unfortunately. US inflation came in as expected, which wasn't the world's worst data, but it just wasn't better than expected. And Canadian data actually did the opposite to what I wanted. It is expected at minus 0.1 and came in flat, so came in better than expected. So those two data points sadly didn't give me the reason to take a trade, and I just left it to be, and finished the week at around about 0.85%, which is absolutely fantastic. If I can make anywhere between 0.5% and 1% in a week, I'm absolutely delighted, because if you do that on a regular basis, that really squeezes you into that 1 to 5% on a regular, consistent basis. So really pleased with how the week's gone. Yes, I'm still not the perfect trader because there are certain elements of this week that have left me a bit frustrated. That was mainly based on my execution and my timing, which could have enabled us to squeeze out a little bit more profit. But on the whole, a pleasing week and a very, very active week as well. Okay, so let's have a look at the trades we took. So first and foremost was pound CAD on Tuesday off the back of those bullish comments. As you can see, I got a shocking entry, got in quite late. This was because I was otherwise occupied at the time and had to rush back to my charts. So it was just unfortunately a call of nature which was preventing me from making another 20-30 pips, so a little bit frustrating there. However, we still managed to squeeze out a nice 41 pips, so an entry of 98.79, which was just here, and an exit of 99.20, which was just up here. It did push a little bit higher, but overall it didn't really go much higher. So I did manage to squeeze out the majority of the move. But however, had I been at my charts a little bit earlier, I'm pretty confident I could have got an execution of around about 20 to 30 pips better, which does add up if you include that on a number of different trades. It starts to add up and really amounts to a nice figure. But hey ho, still managed to squeeze a profit out, which I'm pleased. As you saw, pound CAD continued to go higher throughout the week. So as I mentioned earlier, with teaching you, giving you the opportunity to learn how to do it yourself, you can potentially hold positions longer to squeeze out more depending on your preferences. Me, as a trader managing a sizable fund, I don't like holding positions overnight. I don't like holding positions for long. I like to get in and out quite quickly, purely from a stress perspective. No, nothing other than that. It's a stress perspective. The longer I'm in a trade, the more stressed I can become. However, if I was just trading my own money, then I'd probably hold positions a little bit longer. So I want you to have the opportunity to do that. And the understanding of the dynamics as to why I'm taking these trades. Strong pound off the back of the bullish comments from Bank of England's Carney versus the Canadian dollar, weak based on a run of bad data and the Central Bank of Canada becoming more bearish. So that was the pound CAD trade. Kiwi dollar was the next trade. This was off the back of the News Squawk feed, giving me a very, very nice release of negative information. This was the milk prices from New Zealand. 6654 was my entry. And the market faffed about, but eventually dropped a bit lower and gave us the opportunity to get out at 66.31, which was fantastic. So 66.31 was my exit. A little bit after I got into the trade, so that was a nice trade there of around about 20 pips. So a nice quick one, and it's just really a scalp off the back of that Kiwi news. Sorry, it's about 23 pips. So off the back of that Kiwi news, the bad milk prices, managed to scalp out around about 23 pips there. Again, as you can see, the market sunk lower afterwards and then sunk lower again off the back of the inflation figures. But essentially, this was a bit of a birthday present. The news feed gave me the information out the blue, and I was also having to concentrate my efforts on the CAD trade coming out. So trying to do two things at once was becoming complicated, so I decided to close the Kiwi trade and then concentrate my efforts on the dollar CAD trade. So the final trade of the week was dollar CAD. This one is the one that frustrated me a bit because I did get in late. I got a horrific entry, and this was because I was concentrating on the Kiwi dollar trade that came out just earlier, getting the techs out, etc. So I got a really bad entry. So the market had already pushed 100 pips more or less by the time that I got into the trade. So I got in at 28.83, and because the market then for almost half an hour, 45 minutes just faffed about and went sideways, I just thought to myself, has it got much more legs to go today? And I thought maybe not, because the move has already happened. But hopefully this brings to life the powerful moves driven by news, because I said last week and in the daily report that you received in the morning that if they give us a surprise rate cut, so the market wasn't expecting a cut, it was expecting it to be on hold, we could get a big move. You've seen exactly that now happen. So we're not hindsight trading, we're not talking in hindsight, we prepared for it before, we expected a certain outcome, and if there was any deviation to that outcome, especially to the downside, i.e. a rate cut, there was an opportunity to trade it. Now, dollar CAD has continued to go higher because the dollar is stronger than the Canadian dollar because of what's happened this week. However, I was just a bit unsure as to how much further it could go. The last thing I wanted to do was sit through a bit of a drawdown. Again, talking about the stress perspective, I got around about 20 pips there, and that took me to almost bang on 100 pips for the month, which is really the minimum place that I want to get to, and essentially now we can kick on from that point, squeezing us much further into our target band. So those are the 3 trades. Good trades, all profitable, but could I have squeezed a bit more out of them? Yes, I could. I could have got into the pound CAD trade a few seconds earlier, or a minute or so earlier. The dollar CAD trade I could have got in earlier if I wasn't faffing about with the Kiwi trade, and the Kiwi trade I could have maybe held a little bit further to squeeze a little bit more out on the trade. But on the whole, a pretty good week and sets us up nicely for next week. So let's have a look at next week and see what's coming out. Okay, so next week, Monday, we have some CAD data on what is normally the quietest day of the week. This comes out 1:30, expected to come in at 0.1 versus a previous 1.9, so expecting to drop quite sharply. What will we be looking for is a negative number. A negative number to keep the pressure on the CAD and keep it weak. We then have the monetary policy meeting minutes from the last rate statement from Australia. So we're looking to get any clues in terms of whether the RBA, the Central Bank of Australia, is likely to cut rates anytime soon. Not expecting much here, expecting them to just really remain as they have been over the last couple of months in really wait and see mode. We want to wait and see how the 2 rate cuts we've had this year, how they're impacting our economy. So if that's the case, we probably won't get much of a movement. It's only if they start to hint, yep, we're going to cut rates again, that we'll get a bit of a move on the Aussie dollar. Then as we go into Wednesday, inflation figures out of Australia. This is a biggie. This is a biggie. Why is it a biggie? Because inflation is key to all central banks. Every central bank wants to see inflation improve because it's been very, very bad across the board. So most central banks are wanting inflation to tick higher, and that will then be positive for the local currency, because one of the things that a central bank will do if inflation starts to get too high is raise interest rates. However, Australia hasn't got those concerns at the minute because they are very, very low. However, remember what we said earlier is we're looking for alignment with the bigger picture. What's our bigger picture on the Aussie? We're very bearish on it. They've been cutting interest rates. There's a lot of concerns about the slowdown in China hurting Australia, and the central bank is very bearish. So our bigger picture is that we are bearish on the Aussie. So what do we want to see here? A lower than expected inflation figure, exactly like what happened on the Kiwi last week. Expected at 0.5, came in at 0.4. So if we get a lower than expected figure, this will keep the pressure on the Aussie dollar, purely because the central bank will have further concerns that another data point is proving to be very weak, and they'll potentially have to act again, which means cutting interest rates further. Also be very interesting to listen to RBA Governor Stevens, because when the head of any central bank speaks, it's important to listen into their comments, because their comments are very, very powerful. If they continue to say what they've been saying over the last several months, the market just ignores the comments. However, if they say anything fresh or new, i.e. we're going to cut rates again next month, then the market will react to it. So it's only if you get new comments that the market hasn't heard before. This is going to be really interesting on Wednesday morning, this pound official bank rate votes. So if you don't know what it is, it's essentially the committee, the committee that all comes together and they make a vote on whether they feel that the UK should increase interest rates, keep them on hold, or cut them. Currently, we have a 9-0-0. So 9 believe that we should keep rates on hold. That's what it's been for the last few months. Then we have the to cut, and then we have to raise. So if we have any change to this 9-0, so let's say we get one person of that committee votes for a rate hike and it goes to 8-1, that is positive for the pound. Why? It's because the committee, who essentially will make the decision on a rate hike, is now starting to fight. Rather than all being in agreement, they're now starting to disagree, and people are starting to think now we should be heading towards a rate hike. Even better if we get 7-2, so 2 people start to vote for a rate hike, because that is then a big step forward in regards to raising rates. We had Mr. Carney last week, head of Bank of England, state that the UK is heading towards a rate hike and households should prepare themselves accordingly. Now, the market's expectations of a rate hike is now at fever pitch. So if we then get this deviation, we should see the pound strengthen again. Put the pound against a weak currency pair. So if we had bad data from Australia earlier on in the morning and then get a bullish rate decision here, i.e. we get a bit of an argument amongst the committee, that would be a great opportunity to buy pound Aussie, for example. But you've got a lot of choice in terms of pairing the pound against a weak currency pair. All that would be ideal about the pound Aussie trade is that there is fresh information to support pound strength and support Aussie weakness. Then as we go later into the day, so Wednesday seems to be very, very busy these last couple of weeks. So Wednesday is the big day again this week. Later on in the afternoon, we have the New Zealand cash rate. So this is their interest rate decision. Remember, last time they cut interest rates. Now, the market doesn't expect them to cut it again. So as we can see here, last month, it was cut to 3.25. The market expects it to remain on hold, which is fine. However, if we get the New Zealand Central Bank, the RBNZ, come out and say, no, we're cutting again, then that would be very, very bearish because the market is not expecting a cut. Now, could the New Zealand Central Bank cut rates again? Well, their data since the last release, the last cut, has been atrocious. We've had poor GDP. We've had poor employment. We've had poor inflation. So possibly they could cut interest rates. So we'll have to wait and see. There could be a lot of weakness going through the Kiwi leading into that event. Okay, so, and then if they don't cut rates, it'll all be about the statement in terms of what they say. But I can't really expect them becoming any more bearish than what they were last time. They were shockingly bearish. They were like, we're worried, we're concerned, we're cutting rates, and we'll do it again if we need to do it. You can't really get any more bearish than that. But essentially, it's going to keep the pressure on the Kiwi. The Kiwi is not really a currency you want to be buying right now. You certainly want to be selling it against strong currency pairs. So think the pound, think the dollar. Okay, so as we move into Thursday, retail sales at the UK expected better than previous. So that would again be good for the pound, especially if we've got good data the previous day. Then we move into the afternoon. Core retail sales from Canada, we got some really bad readings last time. They're expected to go positive again. But if we get like what we saw in America last week, where they're expected to come in positive and they came in negative, that would again give us further reason to sell the Canadian dollar. We're going to see Canadian weakness, which we want to pair against strong currency pairs. Unemployment claims from the US, we want to see these continue to get lower. So 285 expected. We want to see it lower than 285. Then we have some further Kiwi data. Trade balance now expected to drop lower, 100 million versus 350 million, which is bad for New Zealand because that's saying that imports are greater than exports. That's not good for their GDP. They're an exporting nation, so they want to be exporting more than what they're importing. Essentially, think of that as a P&L. They want to be selling more than they're buying because that will give them the profit in terms of their GDP, which they can invest in infrastructure and all the elements of an economy that create its either boom or bust. So they want to be seeing a better than expected figure there. If it comes in lower than 100 million, that will be bad for the Kiwi dollar. And then Friday, we finish with some flash manufacturing from Europe. Again, the euro is a very weak currency right now, so if we get lower than expected figures, that should keep the pressure on the euro. Again, be looking to trade the weak euro against strong currency pairs. So, a very, very lively affair. This is quite a long video, but hopefully it's been very, very interesting. I've thoroughly enjoyed this week. It's been great seeing a lot of the things that we've been discussing come to fruition and really give you that proof in the pudding that what we're doing is a tremendous approach to the market. It's a great way to trade, and hopefully, more importantly to me, tuning you in to why these things happen. So when you see a huge move on the Canadian dollar or dollar CAD, you know why that happened, rather than just going, oh, it's just oh, that must be a big trader trading. You know reasons, the fundamental reasons as to why that happened, and then what you can do is take that and then next time prepare for it and trade it. Rather than looking at it after it's happened, you know why it happened, so next time if you get a similar scenario happen, you can then look to take advantage of it. So I'm going to wrap up there, not take up any more of your weekend. I'm going to leave you to enjoy it. Let's hope the weather stays good, and I'll catch up with you very, very soon. All the best.